Hello, welcome to this FRS102 webinar presented on behalf of CIMA. My name's Adrian Gibbons and I'll be presenting some key aspects of the changes introduced by FRS102. I intend to run through the technical material for approximately 50 minutes, and then we'll have 10 minutes at the end of this webinar where delegates can ask questions via the chat box. We have quite a lot of material to talk about, and if you've downloaded the course notes that go with this webinar, you will notice that the course notes are just over 60 pages long. They include a lot of background material that I'm clearly not going to have time to talk about during this presentation. But let's kick off first of all with a very quick overview of where the accounting framework is now. Those of you who deal with corporate entities and statutory accounts, currently when you prepare accounts you'll be using the FRS 2008 if you're a small company. If you're not a small company and you're not a listed entity, then you'll be preparing accounts for medium and large companies using the existing SAPs and FRSs. We have legislation in place now to introduce what's known as micro entities. The micro entity regime took effect for September 2013 year ends and offers a reduced disclosure and a revised accounting treatment for smaller entities within the small company regime. So just to put up on my slide, you should now be looking at the current limits to be a small company and to be a micro entity. So you're a small company if your turnover is less than 6.5 million, your gross assets are less than 3.26 million, you have fewer than 50 employees, and you're a micro entity if your turnover is less than 632,000, your gross assets less than 316,000, and you have fewer than 10 employees. Any 2 out of 3 gets you into the relevant category. You have to be a small company to be a micro entity. Therefore, micro entities is a genuine subdivision of the small company regime. There is what's known as a 2-year drop-in, drop-out rule before you move up or down a category as well. The micro entity rules are in essence an historical cost accruals-based accounting treatment with no revaluation of anything and very much simplified disclosure in terms of the micro entity accounts. Moving forward then, and I've set out in your notes on page 4, the accounting framework for accounting periods beginning on or after the 1st of January 2015. So that is accounting periods beginning on or after the 1st of January 2015. We can see from this slide that over here, medium-sized companies are effectively heading for full version FRS102. So full version of FRS102 will become mandatory for most entities for their December 2015 year ends and onwards. If you're a small company but not applying the micro entity legislation, then small companies will be applying the new FRS 2015. So I've just drawn a red line around that. That's the updated version of the FRS 2008 and takes effect from the 1st of January 2015. And if you're a micro entity over here, then the rules for micro entities are included within the FRS 2015, and as I said just now, are basically historical cost accruals-based accounting treatment for micro entities, excluding revaluation of anything, and that includes excluding revaluation of investment properties, which makes the micro entity regime kind of popular for investment property clients who qualify usually on their turnover and their number of employees. So that's the accounting framework from this January. Moving forward, the accounting framework from the 1st of January 2016 is going to be medium and large companies will apply the full version. So over here, where I've just drawn a red line, medium and large companies will be staying in the full version of FRS 102. Small companies, and this is the exciting announcement, small companies here will be applying the reduced disclosure version of FRS 102, and then micro entities, let me just get rid of my lines, micro entities here will have their very own accounting regime known as the Financial Reporting Standard for Micro Entities, and that's going to be based on an FRS 102 background. Now, what this means in terms of the impact on financial reporting and, for that matter, financial accounting, is that by the time we hit an accounting period beginning on or after the 1st of January 2016, the frizzy will be dead. Nothing on the slide that you're now looking at says frizzy. We have something that says frisme, but we have nothing that says frizzy. So effectively, the frizzy 2015 has a shelf life of 1 year. So most entities will go from the frizzy 2008 to the frizzy 2015 for 1 year, and that's not considered to be a big issue because the move from the frizzy 2008 to the frizzy 2015 doesn't have a lot of significant changes attached to it. But having gone to the frizzy 2015, those entities will then either move into reduced disclosure, FRS 102, for small companies, or they will qualify as micro entities and they will use the Financial Reporting Standard for Micro Entities, which is based on FRS 102. So broadly speaking, everything that we deal with, whether it's a micro company, a small company, or a medium or large company, as long as it's not a listed entity, is going to be applying some version of FRS 102 to its accounts and, more importantly, its accounting treatment. So that's the framework. The other news at the moment, as you can see, is the proposal to increase the limits. At the moment, there is a number of discussion documents out looking at the limits of being a small company. And there are a number of, there is a proposal coming from the government that the small company limits go up to 10.2 million turnover, 5.1 million gross assets, fewer than 50 employees. Any 2 out of 3 gets you into that regime. What we're a little unsure about at the moment is when those limits will go up from, but the betting money seems to be on accounting periods starting on or after the 1st of January 2016. For those of you who are interested in audit and audit exemption, at the moment there are no proposals to change the audit exemption limits. So we may see ourselves moving next year into a framework where we have 2 tiers in terms of audit exemption and small companies. And that would effectively give us a 3-tier small company regime. At the bottom of the small company regime, we'll have the micro entities applying their own standard. Then we'll have those audit exempt small companies applying the reduced disclosure FRS 102, and then we'll have those small companies that still require an audit applying reduced disclosure FRS 102. And then once we move out of the small company regime, our non-listed larger entities will be applying the full version of FRS 102. So whichever way you look at it, FRS 102 is going to make quite a big difference to the accounting framework and the disclosure framework in which we operate. And certainly by the time we get to 2016, virtually all corporate entities will be applying something that has an FRS 102 framework attached to it. So let's talk a little bit about what that means then. This is just on a slide only for the moment. This is my don't panic about FRS 102 slide, because actually for a lot of smaller companies there will be no significant changes. So just very quickly running down what I've headed up as a basic balance sheet here. The accounting treatment for most property, plant and equipment isn't going to change. It's going to be at either historical cost less amortization, or it's going to be at revaluation less some kind of amortization, which is the way you would account for it now. Stock and work in progress, unless you happen to be dealing with a farmer who's elected to account for their agricultural or biological assets in accordance with the special valuation rules within section 34 of FRS 102, stock and work in progress is going to be at the lower cost or net realisable value, as indeed it is now. Trade receivables here. Trade receivables will be accounted for at the expected cash receivable from the debtor. Unless you've got any odd trade receivables, such as a long-term loan due to the company, and particularly long-term loans at something other than a market rate of interest, all of which are going to create different accounting treatments. But a standard commercial trade debtor is going to be accounted for at what you expect to receive from the debtor, which is the way you would account for it now. Trade payables is going to be accounted for at the expected cash outflow to settle the obligation. And again, for trade payables, where it's a standard trading creditor, and there's no funny issues about it, it's not over an extended period, there's no interest-free credit being granted, then trade payables will simply be accounted for at the value that you expect to pay to settle the invoice, which is the way you would account for it now. Largely, within the creditors section, we have loans as well. A lot of ordinary loans, that is straightforward base plus X cost loans, will be accounted for as they are now. The accounting treatment under Section 11 of FRS 102 is the same as the current accounting treatment for ordinary loans that are not classified as complex financial instruments. So it's kind of my don't panic slide. A lot of stuff for standard companies won't actually be changing. So let's have a quick look at FRS 102 in overview. FRS 102 is the financial reporting standard applicable in the UK and Republic of Ireland. It was issued in March last year. It's already been updated once in August 2014. My recommendation to you all would be to download your own PDF file copy of FRS 102 to read. If you do that, make sure at the moment you update the one that's labelled August 2014, and we are expecting a further update to it at some stage early next year. None of the updates are particularly significant, but they are tinkering around the edges with some of the definitions. FRS 102 takes mandatory effect for all entities that do not qualify as small companies from the 1st of January 2015. If you qualify as a small company, then you will have the option to use the FRSI 2015, or you can choose to adopt FRS 102. You can also choose to adopt FRS 102 early, and it can be adopted from December 2012 year ends onwards, but very few clients have exercised that option to adopt early. The standard itself is set out on a topic-by-topic section. So you've already heard me in my brief introduction talk about Section 11, Section 34, Section 35. So there are various sections that deal with specific issues, and we're going to talk about some of those sections as we go through. The standard itself also cross-links to public benefit entities and has some advice for public benefit entities depending on what the entity is, linking into some of the specialist SORPs that have now been updated. That's the statements of recommended practice, which have been updated in some areas. The other big issue that I'm going to talk briefly about in this webinar is what's known as the transitional rules, and in particular I'm going to look at the transition from existing UK GAAP to FRS 102, and that's dealt with in Section 35. Section 35 deals with the transitional rules. So let's just talk about the layout for a moment in terms of what the financial statements will look like. One of the first changes that most people are going to notice when they look at their statutory accounts is that there will be a new layout, particularly for what we tend to think of as the profit and loss account within our statutory accounts. And again, this will create some differences between the statutory accounts and the management accounts. So statutory accounts presentation is dealt with by Section 3 of FRS 102. The section starts off by saying that an entity may use any title it likes in its financial statements as long as they are not misleading. So although the financial reporting standards suggests certain titles and certain headings, you are entitled to replace those headings or titles with almost any heading you like, and therefore we will probably replace some of them with Companies Act 2006 format compliant headings in order that the accounts comply with the current formats within the Companies Act. In terms of the accounts themselves are required to state that they comply with FRS 102, and actually Note 1 to a set of accounts would be an explicit and unreserved statement of compliance with FRS 102. Now that will replace, therefore, the accounting policies as Note 1. The accounting policies will become Note 2. But at the moment, the accounting policies are the first note you come across once you get past the balance sheet and the cash flow statements. That'll be effectively replaced with this statement of explicit and unreserved compliance with FRS 102. If you can't make that statement, then you need to say at Note 1 what areas of FRS 102 you've not complied with and why. In terms of a complete set of accounts then, a complete set of accounts will consist of either a single statement of comprehensive income or an income statement and a statement of other comprehensive income. So effectively the profit and loss account is going to be replaced by a single statement of comprehensive income, or effectively two statements, what they call an income statement and then a statement of other comprehensive income. Our understanding is that in the UK, the most popular choice will be to go for this layout here, where we have an income statement relating mainly to the trading activity of the entity, so it will look a bit like a profit and loss account, and then we'll have a statement of other comprehensive income underneath that. The big difference between what we do now and what will happen in the future is that certain unrealised and non-distributable movements will be shown through the income statement and the statement of other comprehensive income. What that will mean, particularly with valuation movements, so where you've revalued a property, or where you've got an investment property at valuation, or where you've got some financial instruments at valuation, all of those valuation movements will go through either the income statement or the statement of other comprehensive income. And what that means is that the bottom figure will be a mixture of realised and unrealised profits, and it'll also be a mixture of distributable and non-distributable profits. And that's going to be the first area of confusion, and indeed will be a major area of difference between the management accounts and the statutory accounts. So in terms of what my set of accounts looks like, it starts with this statement of comprehensive income in some format. Then we get a statement of financial position at the reporting date. That's the balance sheet. Then we get our cash flow statement. The only exemption in FRS 102 full version from preparing a cash flow is if you are a subsidiary of a group that is preparing accounts, its consolidated group accounts under FRS 102. The individual accounts of the subsidiary may then not prepare an individual cash flow. Outside of that, there are no exemptions from preparing a cash flow at the moment. When we get FRS 102 reduced disclosure for small companies, they will be given the exemption from preparing the cash flows. So we've got our statement of comprehensive income, we've got our balance sheet, we've got our cash flow, then we get our notes, and again the notes will start with Note 1 here, which will be our unreserved and explicit statement of compliance with FRS 102. Then we'll get our accounting policies, and then we'll get our other information and supporting notes. The actual notes to the accounts and the balance sheet will look very much like a balance sheet and set of notes looks like now, because this is a Companies Act 2006 compliance statement. So let's just look very quickly in your notes on page 12. If you're following me on the notes, I've got an example of both types of layout for the statement of comprehensive income and all the income statement and statement of other comprehensive income. So on the slide that you're now looking at, this has got the statement of comprehensive income as an example. This is as a single statement. It looks very much like a profit and loss account, and if I just trog through to the bottom of it, you can see it does incorporate the other comprehensive income statement. The big issue is that this figure here, the 2.906 million, is effectively an amalgamation of realised and unrealised profits, and it's that figure that will feed through into the profit and loss account reserve. As far as FRS 102 is concerned, the only reserves you'll have are reserves associated with the share capital and then your profit and loss account reserve. So there will be no other reserves. There will be no revaluation reserve. There will be no other reserves, because everything will go through the profit and loss account reserve. The other layout example that's in your notes on page 13 at the top there is the two statement layout. So you can see here we've got the income statement. You'll be entitled to call the income statement the profit and loss account for the year. We don't believe that's misleading, and therefore a lot of people will do that, and this comes down to the profit on ordinary activities after taxation here. But then, so that profit you can see is 3.662 million. That profit runs in as the opening profit in my statement of other comprehensive income. Then we get my other valuation movements feeding through, and we end up with a comprehensive income transferred to the profit and loss account of 2.9 million. So again, it kind of looks a bit like the statement of total recognised gains and losses, which is what we have now, but where it's different is the figures all run in to the two statements in order to give us a final transfer to our reserves disclosure, and that's the bit that people are going to find confusing. And of course this figure, the figure at the bottom of this statement, so the 2.9 million, is what will look different from what was on the management accounts, because the management accounts won't normally reflect the valuation movements that come in through fair value accounting, whereas of course the statutory accounts will do. And that's an area that people are going to need to work with in terms of dealing with clients to make sure they understand why the statutory accounts are reporting differently from the management accounts. Just in terms of the statement of comprehensive income, there are a number of little changes between current practice and going forward. FRS102 does not mention exceptional items, and there is no specific requirement to disclose exceptional items on the face of the comprehensive income statement. What FRS 102 does is it requires you to disclose material items, and you have the choice as to whether those material items get disclosed on the face of the statement of comprehensive income or in the notes to the accounts. Let's look at the equity notes for a moment. So moving on in your notes to page 16, section 6 of FRS 102 deals with the changes in equity and produces a statement of income and retained earnings. That statement of changes of equity deals with the profit or loss for the period, the other comprehensive income for the period, changes in accounting policies put through as a prior year adjustment, material errors put through as a prior year adjustment, and then any equity-based transactions such as incoming investments from the shareholders or dividends paid to the shareholders or any other distributions made to the shareholders. One important note while we're here, and that is that we will be required in the future to put in a prior year adjustment for material errors. I've just drawn a red circle around the word material errors. At the moment, you put a prior year adjustment in for a change of accounting policy and a fundamental error relating to an earlier period. Going forward, we'll have to put prior year adjustments in for a change of accounting policy and material errors relating to earlier periods. So one of the things that commentators are saying about the move from existing UK GAAP to FRS 102 is that we'll see many more prior year adjustments coming through in terms of errors identified in earlier periods. If you're following me in the notes, on page 17, there's an example layout of what the statement of changes in equity will look like. There is a much wider requirement to show comparatives in the statutory accounts in FRS 102. Basically, FRS 102 says that you have to have comparatives in for everything unless FRS 102 tells you not to put it in. So what we've got in our example here, this first of all is the comparative disclosure. Draw a big red to all of that is the comparative disclosure for the changes in equity for the previous year. So, and you can see my key headings are share capital, share premium, profit and loss account. Most pure FRS 102 accounts, that is all they will have. In fact, most of them will have just share capital and profit and loss account. You can also see here that this is my statement of comprehensive income that has been transferred into my profit and loss account, and that is effectively split in my disclosure note here between the profit for the year and other gains or losses recognised within the statement of comprehensive income. So it does try to make a little clearer what might be a realised profit and an unrealised profit, but it's not necessarily as clear as all that. This profit for the year here, this 1.450 million, could include non-distributable movements as well as distributable movements, and will certainly include non-realised movements with realised movements. So it is going to be a little bit harder, those of you who are into dividends, it's going to be a little bit harder to tell how much money you have in your reserves that can be used to support legitimately a dividend. Move on to the next slide, and what you get is the current year reserve note, again showing the opening balances brought forward. Same layout, you've got the total income, comprehensive income for the year, and again that is analysed between the two movements within the comprehensive income statement. In this case all we've got is dividends and the revised balance down here carried forward. So that's what the full disclosure will look like. You are also entitled to use, for some companies, what's known as a simplified statement of income and retained earnings. Now, you can use a simplified statement of income and retained earnings where the only changes in your retained earnings are the profit or loss for the period coming from the statement of comprehensive income, the payment of a dividend to the shareholders, and prior year adjustments. So for those of you who deal with smaller entities that will be heading in towards reduced disclosure FRS 102, in essence, what you will produce is a statement of income and retained earnings. So a statement of income and retained earnings, there's an example in notes on page 18. So you can see here we've got a statement of income and retained earnings for the year ended December. It looks like a profit and loss account, and then what it basically does at the bottom is run straight into the reserves note. So we have the retained earnings at the beginning of the year. We've got a prior year adjustment in here to illustrate how a prior year adjustment will be dealt with. And then you've got your brought forward profit from the current financial year, and then your dividends and your retained earnings carried forward. Now, certainly when I first started in practice 30 years ago, that was how we used to do our statement of income, our profit and loss account used to run straight into the reserves note, and we're going back to that in essence with this simplified statement. Section 7 deals with cash flows. There will be some restructuring for cash flows. As you can see, FRS 102 cash flows have only 3 headings: operating activities, investing activities, and financing activities. So this is kind of going back to the old source and application of funds days. Those of you who are perhaps old enough to remember what a source and application of funds looked like. It was very much on the simplified basis. What you will need to do, if you've got an entity that prepared cash flows under FRS 1, you will need to map the headings on FRS 1 across into the headings on FRS 102. And on the slide in front of me, I've got the FRS 1 headings here, here, and here, mapping them across into the FRS 102 headings. There is an element of choice, so equity dividends and return on investments and servicing of finance could be either treated as an operating activity or as a financing activity, depending on what you think the most reasonable layout is. A couple of other changes to cash flows. At the moment we have a definition of cash and liquid resources. That is going to disappear, and back in we will get cash and cash equivalents. Lastly, in terms of cash flows themselves, FRS 102 supports either a direct or indirect method of producing a cash flow, and it also introduces some new disclosure associated with cash flows. In particular, you'll have to disclose separately the cash unavailable for use, with some kind of commentary as to why that cash is unavailable for use. Let's talk a little bit about the transition then. Section 35 of FRS 102 deals with the transition from existing UK GAAP to what will become new UK GAAP, which in essence will be FRS 102 for medium-sized companies, and eventually for a lot of small companies will also have the same transitional rules under FRS 102 reduced disclosure. So in terms of transition, FRS 102 is mandatory for accounting periods starting on or after the 1st of January 2015 if you are not a small company. So the first accounting period that most people will deal with will be December 2013 year ends. Section 35, which is the set of transitional rules, applies to the first accounts in which the entity makes an explicit and unreserved statement of compliance with FRS 102. So even if you comply early with FRS 102, you still have effectively to go through the transitional rules. The transitional rules start by defining the transitional date, and the transitional date is the start of the previous accounting period for the comparatives. So we'll see in a minute. I'm going to follow an example through in this section, and I'll define what the transitional date is. So in the notes on page 23, I've used an example called X Limited. X Limited is a medium-sized company going from UK GAAP to FRS 102, and it has a December 2015 year end. The transitional date, therefore, for a December 2015 year end is the beginning of the comparative period, which is the 1st of January 2014. At the transitional date, you will need to restate your opening trial balance as if you had applied FRS 102 to that opening trial balance. And that means that your opening assets and liabilities will need to be recognised and measured in accordance with FRS 102. And what that's going to mean is that some of your clients, some of the companies will need to recognise new assets or liabilities at a different value compared to what they would have done under the old UK GAAP accounting treatment. So the big issue here is looking at our transitional trial balance and deciding what we've got that may be valued differently under FRS 102 and assessing the impact that has on the view given by not only our comparative accounts but also our accounts for the current accounting period. Now I've got a number of examples in the notes that illustrate some of the key accounting differences, and the first one on page 23 looks at a number of issues. First of all, some of your companies may have investments which you carry at cost, perhaps because you're treating them as a fixed asset investment. If there is a readily ascertainable market value for those investments, then they will need to be at fair value. So the first port of call, I guess, is to look at what investments you're holding, and if there is a readily ascertainable market value for those investments, regardless of how you account for them, so whether you account for them as a fixed asset or whether you account for them as a current asset, they will need to be in at fair value. One of the other big changes is going to be deferred tax. So what we're doing is we're moving from what's known as a partial provision of deferred tax to a full provision for deferred tax. And what that means in practice is that where you've revalued anything, you're going to need to provide for deferred tax on the revaluation, regardless of whether you have any intention of selling the asset or not. So take a property. So we've adopted a policy of revaluing a property over a number of years. At our transitional date, we're going to have to create a deferred tax provision for those valuation movements as if we'd sold the property at the transitional date. So my second example, which is down the bottom of page 23 in the notes, is a property. X Limited has a property that it was revaluing under FRS 15. It has a revaluation reserve, but in the past we've not provided for deferred tax on the revaluation reserve because we have no intention of selling the property. Moving into FRS 102, at the transitional date, we're going to have to establish a deferred tax provision. So X Limited has a December year end. We're doing the December 2015 accounts. Our transitional date is the 1st of January 2014. At the 1st of January 2014, we have to calculate the theoretical capital gains tax that we would pay if we sold the revalued property at its valuation at the 1st of January 2014. Now, a couple of quick points about the calculation of deferred tax. You are entitled to take into account automatic allowances that you get on disposal of a revalued asset, and particularly if it's a property, you would get the indexation gain on base cost. What you're not allowed to do is claim rollover relief. And the reason you can't claim rollover relief is that rollover relief is an election. You may or may not make the election, and therefore the rules say that you ignore any rollover relief claim, and then you calculate what the capital gains tax would be on the disposal of the asset at the valuation at the relevant date. Once you've calculated what the tax provision is, then the double entry is reasonably straightforward. It's debit the revaluation reserve and credit the deferred tax provision to establish a deferred tax provision within your trial balance at the transitional date. The only problem that some companies may have is if their revaluation reserve is not big enough to take the debit entry for the tax charge. If your revaluation reserve is not big enough to take the tax charge, then any excess debit gets charged against retained profits and would be a deduction for distributable profits for dividends purposes. The other big issue that we're going to have to talk about is financial instruments. FRS 102 introduces an accounting principle of fair value for a range of financial instruments, and the most common one that we're going to come across in practice is a forward foreign exchange contract. So in your notes again, I've given you an example of X Limited. At the transitional date, 1st of January 2014, X Limited has a forward foreign exchange contract to purchase €220,000 at a fixed exchange rate of 1.1. The forward foreign exchange contract matures on the 12th of February 2014. So the important issue here is that the forward foreign exchange contract exists over the transitional date. If it doesn't exist over the transitional date, ignore it. If it exists over the transitional date, then you need a value, a fair value, for that forward foreign exchange contract at the transitional date. So, at our transitional date of the 1st of January 2014, we need to value this forward foreign exchange contract as a financial instrument at fair value. Now, at the moment, under existing UK GAAP, we don't recognise the value of a financial instrument at the balance sheet date unless we've adopted the fair value accounting rules in FRS 26. Fairly rare for any of the clients that I look at to have adopted the fair value accounting rules under FRS 26, so I'm guessing that most of you won't represent companies or clients that have done that, and therefore we will need to recognise this as a new asset or liability. So we've contacted the bank who supplied us with the forward foreign exchange contract, and the bank tells us that at the 1st of January 2014 the forward foreign exchange contract has a fair value of £20,000. We need to recognise that therefore as a new asset effectively at the transitional date, and the double entry for that is going to be debit our current assets with a forward foreign exchange contract as a derivative investment with a value of £20,000, and the credit entry would go directly to reserves on our opening trial balance. Just down the bottom of the slide here, I've said what's the tax impact of that. There will be a tax impact for forward foreign exchange contracts. HMRC have published a paper looking at the tax consequences of adopting FRS 102, and they are pretty clear that forward foreign exchange contract movements will generate either a taxable income item or a tax allowable loss, depending on whether it's valued as an asset or a liability. So in terms of putting this in as an adjustment on transition to FRS 102, there are special tax rules that deal with the transition, and broadly speaking, where your adjustment is a valid basis change to a valid basis change, which is what the change from UK GAAP at the moment to FRS 102 would be, then you take out the adjustment in the prior year and calculate its impact on the current year for calculating the corporation tax computation. So there will be a number of adjustments to even the statutory accounts for the ability to calculate the level of corporation tax payable or profit payable for corporation tax purposes, because you'll effectively take out your prior year comparative adjustments and run them through in the current year to see what impact it has on the current year's tax charge. So most of this stuff is change of accounting policy type areas. A lot of it will be in as a quasi prior year adjustment under the transitional rules. Couple of practical points on this slide. First of all, those of you who use software to produce your formatted accounts, is it going to cope with this adjustment to the comparative figures? Most accounting software simply rolls forward last year's figures, and that's going to be a bit of an issue when it comes to FRS 102. So that's the first question. The second question is, and those of you who use firms of accountants to prepare accounts for the companies that you work for, it's going to cost you more because basically the preparation of FRS 102 accounts will take longer. And thirdly, you need to be talking to your directors about how they're going to plan for the impact of FRS 102. So there are a couple of practical points there that you need to think about. In terms of disclosure, on the transition, FRS 102 requires you to have 3 disclosure notes. There are 2 equity reconciliations. So there's an equity reconciliation at the transitional date. There's an equity reconciliation at the comparative balance sheet date, i.e. the end of the transitional period. And then there's a reconciliation of the profit and loss account movement between the 2. So effectively there are 3 disclosures that will need to be made on transition. So in terms of X Limited, the example that I'm following in your notes, there is an equity, a balance sheet reconciliation at the 1st of January 2014. There is a balance sheet reconciliation showing the differences at the 31st of December 2014, and then there is a profit and loss account reconciliation for the comparative year showing the movements between the previously reported profit and loss account and the revised profit and loss account under FRS 102. In terms of Section 35 then and the transitional rules, there are 5 areas where retrospective adjustments to previous accounting transactions are not permitted. I've highlighted all 5 in the notes, but want to talk briefly just about one, and that's accounting estimates. Accounting estimates won't trigger any kind of prior year adjustment. The prior year adjustment is triggered by a change of accounting policy. Where you have an accounting estimate in the restated period, then there is no need to change that estimate, even though at the time you do it, you may have additional knowledge. Quick example on page 27 on that. X Limited had a bad debt at December 2013 it had a debtor of £100,000 and it made a bad debt provision of £50,000 against it. In September 2014, the debtor goes bust, so we know the debtor is actually unrecoverable at £100,000. And the question is, when we restate our comparative figures, should we restate the bad debt provision made at the beginning of the year? And the answer is no, we shouldn't. As long as the bad debt provision made at the 1st of January 2014 was made sensibly and was a realistic provision for that bad debt, then we are prohibited from making a retrospective adjustment to it on transition. So that's the one key prohibition I wanted to talk about. There are also 17 exemptions from making full prior year adjustments on adoption of FRS 102, and again I just want to talk briefly about those. The first one is dormant companies. If you have a dormant company, the move to FRS 102 has no effect on it. You simply leave the dormant company where it is and prepare dormant company accounts and don't change anything until the company is no longer dormant. The next key exemption is for goodwill. If in the past you've acquired some kind of interest in another business and that's given rise to goodwill, there is a technical change in the calculation of fair value, and that means that under FRS 102, the calculation of goodwill may be slightly different than the calculation of goodwill under existing UK GAAP. what this exemption allows you to choose to do is to leave your goodwill effectively at the value it was when you acquired the entity and not recalculate that goodwill on adoption of FRS 102. So as a quick example in your notes on page 29, X Limited has made an acquisition during 2013, so it's acquired a new business. The fair value of that acquisition was based on old UK GAAP, and the goodwill that arose is being written off over 10 years. In terms of moving to FRS 102, we can take advantage of this exemption and not restate our fair values for goodwill at the 1st of January 2014. So effectively we can lock in our old valuation of goodwill. We do, however, have to look at the write-down of goodwill. Okay, you can see here the write-down of goodwill is over 10 years. Now at the moment, FRS 102 says the maximum write-off period for goodwill is 5 years, so unless we can come up with a reliable estimate of goodwill, we will have to consider perhaps reducing our write-down of goodwill to 5 years. If the acquisition was made after the transitional date, 1st of January 2014, then we would need to consider restating our goodwill using the fair value calculation under FRS 102, because the exemption only applies to goodwill that exists over the transitional date. In terms of goodwill, you can see I've made a comment down here at the bottom of this slide. The goodwill we were proposing to write off over 10 years. That's only sustainable if we've got a reliable estimate of the useful economic life. There is a current proposed change to FRS 102, and they're looking at changing the 5-year write-off period and softening it a bit and making it a write-off period between 5 and 10 years. So with a minimum of 5 years, a maximum of 10 years. And our advice to clients at the moment is they may be able to justify having a 10-year write-off fairly easily because of this change that's going to come through early next year. The exemption only applies to goodwill, so any other intangible assets will have to be dealt with under FRS 102, and there are no exemptions from changing their valuation. Another important exemption at the transitional date, and this is on page 31 in your notes, is the ability to adopt what is known as deemed cost. So at the transitional date, all companies will be entitled to adopt an uplift on their fixed assets to what's known as deemed cost. Deemed cost can apply to any fixed asset as long as you can obtain a fair value or a reasonable valuation for that asset. So it could be property, it could be plant, it could be equipment, it could be investment properties, could also be some intangible assets. Deemed cost is going to be either fair value or it could be an old UK GAAP revaluation done before the transitional date, but you will need to provide for deferred tax on any valuation uplift. What it does is it gives your clients, or it gives yourselves, the ability to rebase your balance sheet at the transitional date to some kind of valuation without adopting a policy of revaluation, and that's quite an important choice. So again, for X Limited, on page 32, I've got an example there. They've adopted a policy of revaluation of their property back in 2000. At that stage, the property was cost £50,000 and was valued at 1.2 million. In 2008, the directors wanted to change the revaluation policy because it was onerous, but they couldn't change it without going back to the original historical cost, and therefore they didn't want to do it. At the 31st of December, the property is valued at 1.65 million. They can now drop the valuation policy and lock in the 1.65 million as deemed cost at the 1st of January 2014. The revaluation reserve in that situation stays. You kind of get a historical revaluation reserve that's locked into the balance sheet, and that'll eventually reduce over depreciation, or it'll reduce when you sell the property and realise the revaluation reserve. But you will need to provide for deferred tax on that valuation at the transitional date. The same option also applies to expensive machinery. You can revalue expensive machinery as well if you want to, and lock that valuation in as deemed cost at the balance sheet date. The other important exemption I wanted to highlight for you, which is on page 34, is the exemption regarding leases and an incentive to go into a lease. FRS 102 has a slightly different accounting treatment for lease incentives. So the example on page 34, at the very bottom of page 34, sets this out. X Limited has a 20-year lease, which it took out on the 1st of January 2012, has a rent review every 5 years, and they were given a rent-free period to go into the lease. Under existing accounting treatment, you account for that rent-free period by spreading it over either the full term of the lease or, if shorter, the term of the lease up until the rent is reviewed to market value. So under existing accounting treatment, they're spreading the incentive to go into the lease over 5 years. Under FRS 102, that lease incentive has to be spread over the full term of the lease. There is no other option. However, there is an exemption at transition for leases that exist at the transitional date to stick with your old accounting treatment. So that does mean that if you've got a lease with an incentive and you were accounting for the value of the incentive over the shorter of the lease period, which was up to the date of the rent review, then you can continue to do that as long as the lease existed over the transitional date. So that's quite a useful exemption. There's one other issue that I just wanted to highlight for you, and that's to do with share-based payment transactions. There are no real changes for medium-sized companies. If you've got a share-based transaction, you should have been accounting for the cost of that share-based transaction anyway under existing UK GAAP, but this will be a change for small companies going into reduced disclosure FRS 102 because they will need to account for the financial effect of share-based transactions. In your notes, I've got two disclosure examples for X Limited of the reconciliation statements. So the first example on page 36, this is the reconciliation of the balance sheet at the transitional date. This is the reconciliation of the balance sheet at the comparative period. And then you've got my third reconciliation, which is the reconciliation of the previously here reported profit and loss account to the revised profit and loss account under FRS 102. Just a practical point. Previously, when we prepared our profit and loss account for December 2014 under old UK GAAP, our profit was 463,000. Under the revised treatment of FRS 102, the profit drops to 451,000. Generally speaking, most trading entities' profits go down on the adoption of FRS 102, so you just want to be aware of that as well. I've also presented the notes that go with this in the supporting notes for this course, and there is an alternative layout for the reconciliations. So on page 38, you've got an alternative layout for my two balance sheet reconciliations here and an alternative layout for my profit and loss account reconciliation here. Which layout you use is entirely up to you. So just for the last couple of minutes, and then I'll see if we've got any questions coming through, just wanted to briefly mention three other topics. First of all, financial instruments, particularly complex financial instruments. FRS 102 is a requirement for complex financial instruments to be reflected at fair value within the accounts, and you are going to have to get used to looking at complex financial instruments and understanding what is a financial instrument and what isn't. In the notes, I've set this out in a bit more detail. Just wanted to highlight for people that the sale of a non-financial item, such as a commodity, inventory or property, plant and equipment on a forward contract, is not counted as a financial instrument. So for example here, I've got a contract to buy or sell a property off plan. So you are aware that a developer is building a block of flats on a greenfield site and you decide to get in quickly, and perhaps you do an agreement with the developer to buy one of the flats when they're finished. That is a forward contract. It is a financial instrument, but it's not a financial instrument dealt with by FRS 102 at fair value. So there are some other examples of that in the notes. Financial instruments are dealt with by Section 11 and 12 and should be considered together, and basically you should review all of your financial instruments to see whether or not you have a financial instrument that needs to be accounted for at fair value. A little bit about recognition and measurement in the notes, initial recognition and subsequent recognition. And then towards the end of your notes, I've got an example. This example is going to be quite important to those of you who deal with foreign currency. So on page 47 and 48, down the bottom of page 47 and over onto the top of page 48, just a very quick foreign currency example, and perhaps we'll do this and then see whether we've got any questions coming through. This is a UK company planning to buy a fixed asset from a Spanish supplier. The fixed asset is going to be at €500. The machinery is delivered March 2016, but they take out a forward foreign exchange contract in November 2015 at a fixed rate of €1.5 to the pound in order to effectively hedge the purchase of the fixed asset. What's important about this example is it illustrates that you must treat a forward foreign exchange contract separately from a foreign currency transaction. So the effective accounting treatment at the balance sheet date, which is December 2015, is to recognise the value of our forward foreign exchange contract as an asset. We have nothing to do with the fixed asset at the moment. But then when we actually acquire the fixed asset, we must translate the fixed asset at the spot rate ruling on the date we acquire the asset. At the moment, you can use the fixed rate ruling in the forward contract to translate the asset. You can't do that under FRS102. That effectively generates additional losses and profits associated with the forward foreign exchange contract and the foreign exchange movement, which will be shown in the profit and loss account. So to summarise, the profit and loss account would show under FRS 102 a £3 gain in the December year end, and then effectively a £34 gain in the following year end on the forward foreign exchange contract, and a £20 loss on the payments of the creditor for the fixed asset, giving a net gain of £14 in the second period. The impact of all of this is to put the volatility of foreign exchange movement back into the profit and loss account, even though you've effectively hedged that by having a forward foreign exchange contract. Okay, the other two sections in your notes that I wanted to talk about was deferred tax, and I kind of already mentioned deferred tax. The important issue with deferred tax is you're going to have to provide for deferred tax on absolutely everything that you have. There are no exemptions from providing for deferred tax. And the other slide that I've got, so let me just skip over some of these slides. So there's deferred tax slide there. We will need, and there's an example of how to calculate the deferred tax. And then right at the end, there's my slide on goodwill, really just reminding you that there is this 5-year write-off for goodwill. Now, at the moment, there is a proposed change on goodwill, and they may be softening that so that the write-off period is between 5 and 10 years, but we'll have to wait for that change to come through. Okay, a little rushed at the end there, but quite a lot to get through. This is a big change to accounting treatment, and there will be some key areas. So I'm just going to pause a minute and see if anybody's got any questions. So if you have any questions for me, you can either send me a question via the chat box, or you can send me a question via the question and answer box, both of which are on the right-hand side of your screen. So quite a lot for me to pack into a 60-minute present or a 50-minute presentation. The notes, as I said, have a lot more detail in them if you want to research in a bit more detail some of the key differences that I've talked about. So I can't see too many questions coming through at the moment. If you do have any questions concerning anything I've said, then feel free to email me. My email address is my name, all lowercase, which is adrian.gibbons@swat.co.uk. So that's adrian.gibbons@swat.co.uk. I'll happily answer any of your questions that you should wish to email to me. Okay, so I can't see any questions coming through, So either I've stunned you all into silence, or you're all figuring out how to use the chat box or the question and answer box. Oh, somebody said thank you, and it's very kind of you. Just to summarise briefly then, we'll close at past. There are a number of key areas I've highlighted for you. Deferred tax is one of them. Deemed cost at the transitional date is one of them. The treatment of foreign currency transactions is one of them. The requirement for valuation movements to effectively go through the profit and loss account is another one of them. All of these areas will create differences between the management accounts and the statutory accounts, and those of you who do management accounts will need to look at it quite carefully. Okay, got one question come through. Somebody said, can we still use 20 years as our useful economic life on acquisition if we believe it's supportable? The answer is yes, but you have to have a good reason for it. So what the rules say is that you can use any useful economic life you like, providing you can demonstrate that that is a reliable way of that is a reliable estimate of the useful economic life of the goodwill. And if that is a reliable estimate, then you can use 20 years. The issue I would have with that as an auditor is whether you've got a reliable estimate that justifies 20 years. And I think that's unlikely, but you may have. Another question coming through. Are there any other implications for charities or public sector entities? The answer to that is yes, there is. We have two new charity SORPs that deal specifically with charities. We have a charity SORP for FRS102 and a charity SORP for the FRSI 2015. So there are some quite significant changes for charities, and those of you who deal with charities really need to go on a specialist charity course dealing with these issues. Got another question. How do we decide if if we should go for FRS 102 accounts or IFRS reduced disclosure? The answer to that is that if you're applying IFRS reduced disclosure, it may well imply that you're a member of a group where the group accounts are being prepared under IFRS, and therefore you're taking advantage of the reduced disclosure regime. There is a reduced disclosure regime also within FRS 102, but the choice of the two accounting and reporting regimes may depend on what the group wants you to do. Whatever happens is the group won't want you to stay outside of FRS 102 or IFRS. But in terms of how you decide between the two, that's quite a difficult question, and you'd need to look at the impact on your assets and liabilities of adopting either IFRS or FRS 102. They are very similar reporting regimes, but they're not the same. And so you'd need to discuss that probably with your accountant. So I'm just looking, and we've got some questions coming through now. Yep, so that's thank you very much, guys. Yeah, I mean, again, in terms of public sector accounting, there will be some further guidance for public sector accounting, but particularly with charities, there are these two revised SORPs. One question. I'll do one last question. Let's see what this question is. I have a revaluation reserve at the 1st of April 2014. Will this need to be transferred to an unrecognised gains and losses? The answer is no. If you have a revaluation reserve that stays there, then the revaluation reserve gets locked into the balance sheet and only moves as you depreciate the revaluation reserve against the higher depreciation on the revalued asset, or you sell the asset and the revaluation reserve becomes realised, and then it gets transferred into the profit and loss account. Okay, thank you. Somebody saying how much they enjoyed it, and I've dealt with the revaluation reserve one. Another question coming through. When restating assets and liabilities, will this only be for additions from the 1st of April 2014 if I have a 31st of March accounting year end? If you have a 31st of March accounting year end, your first set of accounts for FRS 102 will be the 31st of March 2016. So your comparative period will be the 31st of March 2015. So you're right, 1st of April will be your transitional period. Note relates to all assets held at the transitional date. So it's not the option to have your assets at deemed cost relates to all assets that you hold at the transitional date, not just those that you acquired later. Somebody has said, thank you very much, very interesting session, much more informative than the PwC session. Yes. Okay, that's lovely. Somebody's asked whether the slides are available for download. I'm happy to make the slides available for download. I'm just not quite sure how I do that. So let me just consult with the technical team and we'll see where we go from there. Okay, I'm going to close the webinar now for the moment. If you would like the slides, you could, I suggest, just email me or email us at SWAT and ask for the slides and we'll email them out to you. Okay, thanks a lot. Enjoy the rest of your afternoon. Thank you very much.